Hi and welcome to Swissquote's Daily Market Talk. It's Monday, June 2nd. The new week starts with renewed tensions on the global trade front and a jump in oil prices on escalating tensions between Ukraine and Russia. So we have a lot to watch this week on the economic calendar as well, including the PMI numbers from around the world, the European Central Bank and Bank of Canada rate decisions, and US jobs data. So tune in. We will talk about all that. But before we do, please keep in mind that opinions are my own and this is not financial advice. Time flies. We're already June and the month of May has ended with a whopping 6% advance for the S&P 500, defying the sell in May and go away saying in Wall Street among investors, pointing at a generally unfavorable seasonal trend for the month of May. But the S&P 500's performance in May is somehow hiding a few issues on the US debt and the global trade fronts, because the past few weeks were, as you know, marked with less than ideal news and events for the United States despite the resilience of the bulls in the equity markets. First, the US debt got downgraded at Moody's 2 weeks ago, remember? And that, combined with Donald Trump's beautiful fiscal package that's certainly ahead, has risen the worries among investors about the sustainability of the US debt levels, also combined with the relatively high interest rates in the US and the Fed's reluctance to cut the interest rates. So, the US 30-year yield spiked past the 5% psychological mark in May before easing below this level. But elsewhere, the sell-off in Japanese long maturity debt also sat in the headlines last month, hinting at increasingly falling confidence among investors regarding some Western governments' ability to find financing to back their unsustainable budgets. Note that Europe is somehow benefiting from these sovereign outflows from the Japanese and US markets, as the European governments were quite strict in containing their debt levels. So even with the prospects of increased government spending, especially in Germany, the German debt looks like a place to go for investors willing to remain within the sovereign bond space but diversify their risks. Other assets obviously include gold and Bitcoin. Then, the trade tensions are heating up again. Not only Donald Trump doesn't look like he cares about the rising questions about the legitimacy of his tariff policy, but he also accused China on Friday of violating the trade truce that they signed in Geneva earlier this month. Well, the Americans also spanned last week, remember, canceling Chinese student visas in the country's biggest colleges and imposing fresh restrictions on chip designers' businesses in China. China, in response, said that the United States is imposing discriminatory restrictions toward China, which is obviously true. And cherry on top of it all, the US also announced to increase tariffs on steel and aluminum imports to 50% from 25% announced earlier, perhaps to help the recent deal between the US and Nippon Steel of late. So iron ore futures tanked 3% in Singapore last week and remain under pressure this morning, while Wisdom Tree's Industrial Metals ETF has been unable to reverse trend on May trade optimism and is back to diving again, and that obviously on the back of rising global trade tensions and prospects of lower demand. And the renewed tariffs on steel and aluminum will also likely throw some cold water to the negotiations between the EU and the US, because the European Union's metal exports to the US represents around 1% of the total exports value, but it does obviously have severe consequences for the Europeans' already struggling industry. So that's an affair to be followed this week. In the financial markets, in the FX markets, the US dollar opens the week under pressure again. Now, data-wise, note that Friday brought some good news for the US economy and the Fed watchers. The core PCE index in the US, which is the Fed's favorite gauge of inflation, came in line with expectations. So that was good news, but better. The headline PCE printed a softer than expected figure, helping to boost dovish Fed expectations and the expectations that the Fed could cut the interest rate sooner rather than later and support the US dollar. But the US dollar begins the week under pressure again, unfortunately, and that's obviously due to re-escalating trade tensions between the US and the rest of the world, backed by the US debt worries. So asset managers remain heavily short the US dollar, with the consensus among them pointing at further losses in the US dollar against most G7 majors. In this respect, the euro dollar looks better bid in the very early hours of the new trading week, as a set of flash CPI figures from the major Eurozone economies last week came in sufficiently soft to point at easing inflation in May toward the European Central Bank's 2% policy target. So the aggregate figure is due tomorrow, but the ECB does are out and betting that the bank will cut its interest rates by 25 basis points when it meets this Thursday. And speaking of rate cuts, the Bank of Canada is also expected to lower its rates by 25 basis points on Wednesday this week to counter the economic damages of the heated trade war with the US and also the impact of lower oil prices on the economy. Now, speaking of oil prices are up this morning at the time I'm talking here on the back of rising geopolitical tensions between Russia and Ukraine, as Ukraine has reportedly launched drone attacks deep inside Russia. So the latter, the rising geopolitical tensions between the two, is obviously counterbalancing the announcement of this weekend of an additional 411,000 barrels per day that OPEC will be bringing to the market starting from July. But obviously that announcement from OPEC was expected and it was wildly priced in. So the knee-jerk reaction to that number, 411,000 more barrels per day in the market, has been positive if there was any reaction, on relief that the number matched the previous announcement and expectations and was not higher. Nevertheless, note that the price rallies on geopolitical tensions tend to remain short-lived in the absence of significant escalation and significant U-turns, and they tend to serve as interesting top-selling opportunities for traders who are actually playing the higher oil supply and lower demand prospects narrative of the moment for the oil market. As such, a rise above the 50-day moving average that stands near the $62.90 per barrel level for US crude could actually be interesting top-selling levels, while the major resistance to the year-to-date decline in oil prices stands near the $65.35 per barrel level for US crude, which is the major 38.2% Fibonacci retracement. In equities in China and Japan are down this morning, while Hong Kong's Hang Seng Index fell nearly 2% on news that New World Development, which is a property developer, slipped further into distress amid delayed interest payment on some of their bonds, reminding investors of the ongoing property crisis in China beneath the AI shine. And elsewhere, the Australian ASX 200 index is under pressure this morning, as miners of industrial metals there are under pressure, while gold miners are supported by the rising geopolitical and trade tensions that back gold prices. The European and US futures are also in the negative this morning, pointing at a bearish start to the new month and the new week, with the exception of FTSE futures are slightly in the positive at the time I'm talking here, probably backed by an early rally that we saw in oil prices this week. So this week, we will be watching the PMI numbers from around the world starting from today, then the US jobs data throughout the week, and the latest earnings from Crowdstrike and Broadcom. Besides, obviously, the trade headlines and the trade news that will probably dominate the overall market sentiment still and continue to provide the global tone to the markets. But all the data and the reports are still important to watch in order to, determine what's going on underneath the trade pressures. So we will be watching all of that, but trade first. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.